Popular culture suggests that reaching a seven-figure net worth requires a massive salary, a lottery win, or a specialized mind for day trading. The data tells a different story. Saving $100 a month from age 25 yields over $1 million by 65. Delaying 10 years drops your balance to $300,000. That gap erases $700,000. Accumulating wealth is a process governed by the specific, predictable variables of a mathematical equation. The difference between financial security and struggle is often determined by how you execute the law of compound interest. To understand the mechanics of growth, we look at the central equation for compound interest. We begin with P, representing the principal, the initial sum of money. You satisfy the principal variable through dollar cost averaging, investing a fixed amount at scheduled intervals, regardless of the market. This method exploits volatility. When prices are low, your fixed contribution buys more shares. When high, it buys fewer. Automating this schedule bypasses the common failure of trying to time the market based on fear or greed. Dollar cost averaging ensures the principal is consistently fed, replacing emotional decision-making with automated discipline. Now we look at the exponent T for time. This illustrates the gap between simple linear interest and compound exponential interest. The 8-4-3 rule maps how this growth feels over a 15-year period. During the first 8 years, progress is slow. Nearly all the growth you see is the result of your own out-of-pocket principal contributions. By the final 3 years, the momentum shifts. The accumulated interest now generates massive new earnings that can exceed your original contributions entirely. Ultimately, time is the underlying engine that converts your modest early deposits into an accelerating, self-replicating wealth machine. A specific friction erodes this mathematical potential: management fees. This is a primary focus for financial regulators monitoring how investment costs impact the public. Because of the nature of exponential growth, a fee of 1% does not just take a small linear cut, it siphons off the capital that would have generated its own future returns. This chart compares two $1 million portfolios over 30 years. One pays a low 0.1% fee, the other pays a 0.5% fee. That small difference results in a lost value of over $1 million to the silent erosion of fees. Friction alters the final trajectory of your growth curve. Minimizing these fees is a mathematical necessity for long-term wealth. The path to a seven-figure retirement is optimized when you automate the principal, maximize the time, and eliminate high-cost friction. Achieving this status provides the security to remain financially independent and ensures you will not become a burden to your family in your later years. This equation is a tool for achieving financial self-sufficiency. It creates the possibility of leaving the workforce on your own terms. The practical steps are to start investing immediately, set up an automated dollar cost averaging schedule, and utilize low-cost index funds. Index funds are a type of investment that holds every stock in a specific market index, like the S&P 500, to keep fees to a minimum. The math of compound interest is indifferent to your background or career. It only requires you to set the equation in motion and allow the variables to do the work.